how Warren Buffett spots stock manipulation, and how you can spot these manipulations as well. This is a step-by-step guide. I have never seen such a video on YouTube, and this is the reason I wanted to make it, to help spread the word and prevent investors from losing money. Let's dive in. Warren Buffett has a simple habit that surprises a lot of people. Before getting excited about earnings or fancy narratives, he reads the balance sheet, slowly, over years. At the 2025 Berkshire Hathaway meeting, he said he actually spends more time on balance sheets than on income statements because some risks are harder to hide there. He likes to study them over 8 to 10 years and see what the figures truly say and what they can't say. So, if you're new to investing or you don't know exactly how companies can manipulate you by using the balance sheet, this video will be extremely important for you. Think of the balance sheet as a company's X-ray. It shows what the business owns and owes at a point in time and how it's been financed. Today we'll turn that X-ray into a checklist you can use. Why start with the balance sheet? Because return of capital matters before return on capital, as Buffett says. While the number one rule of investing according to him is to never lose money, rule number 2 is to never forget rule number 1. This is why the analysis of the balance sheet is a crucial part of investing. A great story can still run out of cash, a fast-growing company can drown in debt, and clever accounting can dress up the income statement for a while, but the balance sheet, viewed across time, often gives the game away. Buffett's line in 2025 captures this. You can learn more from balance sheets than most people think, if you know where to look. Let's walk through the balance sheet from top to bottom, translating every line into plain English, showing the main risks, and giving you an example for each one. The first part of this statement are the assets, meaning what we control that can help us make money. The first item on every balance sheet are the cash and cash equivalents. This means the money in the bank and near cash, like T-bills, which stands for short-term bonds. Why does it matter? Because cash is oxygen. It pays suppliers, salaries, and interest when things get tough. What are the risks and tricks with this line item? Restricted cash or cash tied to a lender isn't truly free. A big cash pile can look safe, but if liabilities are larger or due soon, the oxygen runs out. Berkshire, Buffett's company, keeps a fortress cash position, so it's never forced to beg a bank. That philosophy was reiterated in 2025. To be sure the risks here are manageable, you want to check the cash-to-debts ratio. It has several variants, but I tend to be more conservative, just like Buffett, and I use the cash to total liabilities ratio. The total liabilities include both short and long-term debts a company has. In general, you want your company to have a cash to total liabilities ratio of 20% or more. The higher the number, the better. This means if the total liabilities of a company are 100 billion, the company is best to have at least 20 billion in cash and cash equivalents. Next on the balance sheet are marketable securities / short-term investments. Those are longer-term bonds or stocks meant to be liquid. The risk here is that liquid can turn illiquid fast in a crisis. Check notes for any pledges or claims on those assets. Compare the marketable securities to the short-term debts to see if the company could cover a bad quarter or a bad year. In just a few short minutes, I will go through the short-term line in the balance sheet. A very key segment of the balance sheet are accounts receivable A/R. It is an important line item which could hide a lot of statement manipulation techniques. Accounts receivable means sales made but the cash is not yet collected. The red flag test here is as follows. If accounts receivable grows much faster than revenue, customers might be slow to pay, or sales quality is dropping. Look for the allowance for doubtful accounts, which for short is called AFDA. This means the management's estimate of what won't be collected. If there is such an estimate, you can find it in the company statements. The trick companies use here is under-reserving. Some companies overstate what amount of the accounts receivable will actually be paid back. This inflates assets and profits today. Over-reserving creates cookie jars to release into earnings later. Remember to always check the amount of accounts receivable in relation to revenue growth and in relation to other items on the balance sheet. If you want to be extra safe, you can subtract a certain amount from this line item so that you can be more sure in the numbers and not be blindsided. For example, Bristol-Myers in the early 2000s used an accounting trick called stuffed channels. I will explain it in a second. During that time, Bristol-Myers began shipping excess products to wholesalers to book sales, leading to SEC action and a $150 million settlement. Channel stuffing is a form of earnings manipulation where a company sends or pushes more products to distributors or retailers than they can realistically sell, usually near the end of a reporting period, to inflate sales revenue temporarily. How does this manipulation work exactly? A manufacturer or supplier ships excess inventory to its distribution channel, wholesalers, retailers, etc. The company records those shipments as sales, even though the distributors haven't sold the goods to end customers. Sometimes companies offer deep discounts, extended payment terms, or return rights to entice distributors to accept more inventory than they need. But why do companies do it? To boost short-term revenue and make financial results look better, often to meet quarterly earnings targets, satisfy investor expectations, earn performance bonuses tied to sales. And why is it a problem? The inflated sales aren't sustainable and future periods suffer because the distributors are already overstocked and will buy less later. Eventually, the company may face returns, write-downs, or restated revenues. After accounts receivable comes the inventory line on the balance sheet. This, of course, is stuff you plan to sell. The quick and easy red flag test here is if inventory rises faster than sales, the company may be building a glut that will need write-downs later. Write-downs mean losses. Compare two metrics to figure out if all is okay here. They are days inventory and inventory turnover over several years. Here are the formulas for both. As all other fundamental metrics, they are quite easy to use. Just divide, subtract, multiply, or add together. This is why Buffett has said that if you have an elementary school diploma, you can be a great investor, due to the fact the mathematics we use are very rudimentary. To find the inventory turnover ratio, you just need to check the COGS, which is stated in the income statement just below revenue, and then find the average inventory for the given year. Average inventory means you add the last 4 quarters worth of data for the inventory and divide it by 4 so that you find the average for the whole year. And for the days inventory standing, as you see, you divide 365 days by the inventory turnover number. I have a completely free fundamental analysis guide for all balance sheet metrics in the description of the video. You can grab a free copy. I'll place it as a pinned comment as well. The trick companies use with the inventory line item is often to hide weak demand by pushing product to distributors, channel stuffing, which makes revenue look good now but leaves distributors full and future sales weak. Other examples like Bristol-Myers are the Sunbeam. They used bill and hold and channel stuffing in the 1990s. The SEC detailed the distortions. Bill and hold is another way a company can inflate inventory numbers and/or revenue. It is a revenue recognition arrangement where a company bills a customer for goods but holds onto the goods instead of shipping them immediately, usually at the customer's request. It's a legitimate but sensitive accounting practice because it can easily be abused to inflate revenue before delivery actually occurs. Other examples of bad practices are the cases of Lucent and others, which were classic cases of stuffing to hit short-term targets. While Cisco in 2001 had to write down approximately $2.2 billion of inventory when demand evaporated, proved that excess piles eventually become losses. Too much inventory and growth in inventory can often lead to mismanagement of company funds. The lower the inventory turnover, the better. Property, plant and equipment, or for short PP&E, is the next asset we must double check. Those are factories, equipment, and buildings, expensed slowly via depreciation. Over time, these assets lose value, and the loss of value is a real cost, but it is a non-direct cash cost for the business. If your car has a working life of 10 years and costs $100,000, this means that in the 10th year you must buy a new one. Each year the car loses $10,000 of value, but it does not come out of your pocket each year. At the end of the 10th year, you just have to come up again with another $100,000 to buy a new one. The depreciation expense exemplifies and tracks this yearly non-cash expense, which is found when you divide the current price of your asset by the number of well-functionally operating years it has. The red flag test here is when times are tough, managers can massage earnings by changing depreciation assumptions. They place longer useful lives, higher salvage values to cut expenses now. Salvage value is the estimated value of an asset at the end of its useful life, which is the amount that can be realized from its sale or disposal, often for parts or as used equipment. One example of this kind of manipulation has happened to Waste Management Company. They extended truck lives and inflated salvage values, classic depreciation games, to reduce expenses and overstate earnings according to the SEC. To go back to my car example, If I change the expected life value of my vehicle from 10 to 20 years, this means my yearly depreciation cost drops from $10,000 to $5,000. This would mean my earnings for this year will increase by $5,000. This is called accounting fraud. The simple translation is if a company suddenly reports higher profits while capex and asset wear and tear haven't changed, scan the footnotes text in the company financial statements. Check, did useful lives get longer overnight? Intangible assets and goodwill come after the physical assets on the balance sheet. Intangibles are patents, customer lists, licenses or brand values, and goodwill is the premium paid above fair value in acquisitions. Goodwill isn't amortized under the US GAAP, it's tested for impairment and can be written down in big chunks. Impairment losses, including those from goodwill or other intangible assets, deductions from net income. If goodwill is a high number or a growing number in a company's balance sheet, be very careful. If this number is revised, and it often is, the earnings of the company drop in proportion with this revision. The same goes for intangible assets. This is why Buffett places very little value, if any at all, when it comes to these two assets. Most of the time in times of turbulence or distress, they are going to zero. The risks and/or tricks here are that aggressive deal-making can stack up goodwill. To explain it again, if company A buys company B above a reasonable price, meaning above its fair value, this overpayment is placed under the goodwill number. If the deal disappoints later, a sudden impairment hammers equity and earnings, so please be careful here. Metrics which often deduct these line items are tangible book value per share and the tangible price to book ratio, as well as the return on tangible equity. In order to spare time here, I talk more about them in my free guide down in the description. Good example of stocks manipulation using goodwill and intangible assets is Kraft Heinz in 2019. They took approximately $15.4 billion impairment loss tied to goodwill/brands after years of overestimating asset values. The stock plunged and the company later paid $62 million to settle an SEC case on other accounting issues. Many investors say intangible reporting is poor. The CFA Institute has urged better disclosure because current rules leave too much room for judgment. There are many more ways a company can manipulate its number using the balance sheet, but these are some of the most used ways. In future videos, I can explain more on the topic if you like this video. Now comes the part with the liabilities. This means what we owe and when it comes due. Let's start with the accounts payable and accrued expenses. What do they mean? Bills owed to suppliers and accrued costs, which can be taxes due, salaries, rents, and other similar upcoming billings. Healthy signs are flexible terms and natural growth with sales. The red flag test here is if accounts payable are rising much faster than inventory, this can mean the company is stretching suppliers. Sometimes this is hidden via reverse factoring, also called supply chain finance. This happens when a bank pays suppliers early and the company repays the bank later. It looks like trade payables but behaves like debt and can vanish in a crisis. Let me explain this in a more clear manner, as it is quite important to understand. Supply chain finance, SCF, also known as reverse factoring, is a financing arrangement that helps improve cash flow for both buyers and suppliers in a supply chain. At first glance, it's essentially a win-win payment solution. Suppliers get paid earlier, buyers get to pay later, and a financial institution bridges the gap. How does it work exactly? Here is a step-by-step example. The supplier delivers goods to the buyer and issues an invoice. The buyer approves the invoice for payment, confirming goods were received. Instead of waiting 60 to 90 days for the buyer's payment, the supplier sells the approved invoice to a bank or SCF platform at a small discount, so the banks get a fee. The bank pays the supplier early within a few days. The buyer then has to pay the bank later on the original due date. Risks or concerns here are about accounting transparency. If misused, SCF can mask leverage, since payments look like trade payables, not debt. There is also dependency risk. Suppliers may become too reliant on early payments. Also, the complexity becomes higher. Requires robust systems and cooperation among all parties. Supply chain finance, SCF, can mask leverage because it effectively creates hidden debt that doesn't appear as a loan or borrowing on the balance sheet, even though it behaves like one, as the buyer has a debt obligation to the bank. This trick, called reverse factoring, has contributed to high-profile collapses like Carillion and drew warnings from Moody's and others for hiding liquidity risk and debt-like obligations. The Green Seal saga made that painfully public. The simple check you can use is to search the footnotes for supply chain finance, reverse factoring, or payables finance. If disclosure is thin, your risk is higher. The next line in the liabilities part of the balance sheet are the short-term debts and current portion of long-term debt. These are borrowings due within a year. This makes them short-term borrowing. If the borrowing duration is longer than 1 year, it is stated in the long-term debt part of the statement. A red flag test which you can make here is to ask yourself, can cash plus liquid investments cover these with room to spare? Refinancing is not guaranteed in a crunch. The three most used fundamental metrics to assess the short-term liquidity risks are the current ratio, the quick ratio, and the cash ratio. The most conservative of all is the cash ratio. If each of these three metrics is above a figure of 1, this means the short-term debt risk is negligible. I talk more about them in the free document in the description so that we spare time now during the video. Let's now go through the part with the long-term debt. As I just explained, these are borrowings due beyond a year. The Warren Buffett angle here is that he hates asset-liability mismatch and refuses to rely on banks. A fortress balance sheet lets you survive storms and seize bargains. Simple checks you can use are the interest coverage ratio, which checks the operating income in relation to interest payments. Ratios above 10 are considered safe. Also, you can check if tangible assets are higher than the total liabilities, which will be a good sign. Check also for so-called maturity walls. These are big lump debt payments which are due soon. Also see if there are some debt covenants. A debt covenant is a legally binding condition in a loan agreement that sets specific rules for the borrower to follow. These conditions are designed to protect the lender's investment by ensuring the borrower maintains financial stability and operates within certain limits. An interest and often neglected part of the liability statement are the deferred revenues, also called contract liabilities. This means cash collected now for products/services to be delivered later, most often software or subscriptions. A healthy sign is if you see growing deferred revenue. This can signal sticky future revenue. A trick SaaS companies use is to pressure for earlier revenue recognition, which comes in the form of generous terms or side agreements. They can bloat receivables and shrink future growth. A good case example to know is the HP/autonomy saga. It involved allegations around revenue recognition and later a massive write-down. US and UK proceedings dug into the accounting mechanics. Your lesson isn't the legalities, it's that aggressive recognition often leaves a trail in receivables, deferred revenue, and later impairments. You never want to see impairments in the stocks you own. This always leads to a bloodbath in the stock value, loss of trust, and a diminished willingness for future investor involvement. Think of these as the greatest hits of accounting shenanigans. Each leaves footprints on the balance sheet. Grab your free fundamentals guide for balance sheet health down in the description, as we didn't have time to cover all in this video, and comment the word Buffettology. If you stayed until this part of the video, it will show me you watched it until the end, and this truly means the world to me. Subscribe for more. I'll see you in the next video.